A single percentage point change in tariffs can erase billions in market value for a global corporation overnight. This is the reality of today's U.S. China trade landscape. The latest escalation in this trade dispute has sent shockwaves far beyond Washington and Beijing, hitting America's factory floors and forcing tough decisions that affect thousands of workers. This isn't just about numbers or politics. It's about real consequences and the chaos unleashed on global supply chains. When the world's two largest economies clash, the collateral damage is immense, especially in sectors like aerospace. Boeing, a titan of American manufacturing, finds itself at the center of this storm. Its fortunes tied to the volatile relationship between the U.S. and China. As tensions rise, Boeing's strategic advantage in China has become a major vulnerability, targeted by Chinese retaliatory measures. We'll explore how these moves have forced Boeing to pause production and what this means for global trade and supply chains. In our interconnected world, economic decisions in one capital can have profound effects half a world away. The current crisis is the latest chapter in a years-long U.S. China trade dispute. In early 2025, the U.S. announced new tariffs on $200 billion of Chinese goods, citing concerns over intellectual property theft and a widening trade deficit. This 25% levy targeted products from electronics to machinery, signaling a shift from negotiation to aggressive economic pressure. The move, coming after seemingly productive trade talks, surprised many and drew criticism from global allies who warned of a looming economic slowdown. Financial markets reacted instantly. The Dow dropped over 800 points in 2 days, and investors braced for China's response. Unlike previous rounds, these tariffs touched nearly every sector, making clear the U.S. was willing to endure short-term pain for long-term goals. The decision forced Beijing's hand, making a strong response politically necessary. The world watched as the stage was set for a new, more dangerous phase of the trade conflict. This escalation would soon have direct, tangible impacts on American industries. The question was no longer if China would retaliate, but how, and how hard. The answer would reshape the global economic landscape. China's response was swift and strategic, not just a tit-for-tat tariff exchange. Unable to match the US dollar for dollar, China targeted politically sensitive sectors, especially agriculture and aerospace. Within 48 hours, China announced tariffs on $110 billion of U.S. goods and introduced non-tariff barriers, like regulatory delays and customs inspections. The aim inflict maximum pain on key U.S. industries while minimizing self-harm. Agricultural products from swing states were hit hard, pressuring the U.S. administration at home. But the real leverage was in aerospace. China hinted at shifting future aircraft orders from Boeing to Airbus, sending a powerful geopolitical signal. This wasn't just about economics. It was about showing China's market power as a strategic weapon. China's approach evolved beyond tariffs, using regulatory measures and strategic purchasing to create uncertainty for American companies. The message to Washington: the costs of this trade war would be felt deep within America's most iconic corporations. Domestic lobbies for a change in U.S. policy began to grow louder. The precision of China's retaliation marked a new era in trade conflict. Boeing, a symbol of U.S. industrial strength, became the perfect target for China's retaliation. China is Boeing's largest market. 1 in 4 planes it builds is for a Chinese airline. Instead of direct tariffs, China used regulatory delays and strategic ambiguity, slowing orders and stalling certification of new Boeing models. This uncertainty crippled Boeing's ability to plan production and deliveries. Billions in orders were effectively held hostage, while Airbus suddenly found itself in favor with Chinese officials. State media praised Airbus, and high-profile visits signaled a potential shift in future orders. The message to Washington was clear: China could redirect its trillion-dollar aviation market if U.S. trade aggression continued. For Boeing, the threat was existential. Its access to the Chinese market was now a bargaining chip in a geopolitical standoff. The strategy was subtle but devastating, leveraging China's market power to maximum effect. Boeing's vulnerability exposed the risks of global interdependence in an era of rivalry. The aerospace industry's fate now hung in the balance. The world watched as the stakes grew higher. For Boeing, the crisis escalated rapidly from a business challenge to an existential threat. Trapped between U.S. policy and Chinese retaliation, Boeing couldn't oppose its own government or risk losing its biggest customer. The financial impact was immediate. Orders from China slowed, regulatory uncertainty soared, and Boeing's stock dropped 15% in weeks. Dozens of completed aircraft sat idle, undelivered, creating a costly inventory problem. The supply chain backed up, payments stalled, and Boeing was forced to lease extra space just to park finished jets. Cash flow dried up, threatening investment in future projects and straining relationships with suppliers. The dilemma: keep producing planes that can't be delivered, or slow down and risk further damage. Boeing's leadership faced impossible choices as the crisis deepened. The company's future, and that of its workers, hung in the balance. On August 5, 2025, Boeing announced a temporary pause in production of its 737 MAX and 787 Dreamliner lines, its most popular models in China. Production would be cut by 40% for at least 90 days, directly impacting thousands of workers in Washington and South Carolina. While layoffs were avoided, rolling furloughs and non-renewal of temporary contracts created anxiety across Boeing's workforce. The ripple effects hit Boeing's vast supply chain, threatening the survival of smaller suppliers who rely on steady orders. For many, a 40% reduction was a potential death blow. The move was financially necessary to stop the cash bleed and manage inventory, but it was also a public admission of the damage inflicted by the trade war. Headlines across America told the story: a premier manufacturer forced to idle production because of global politics. The message was clear: no company is immune to the fallout of geopolitical conflict. Boeing's production pause was just the most visible sign of a broader economic crisis. American farmers, already battered by years of trade disputes, saw exports to China collapse. Soybean sales dropped 90%, triggering bankruptcies. The tech sector suffered too, as U.S. semiconductor firms faced tariffs and non-tariff barriers, while China accelerated efforts to build its own chip industry. The risk wasn't just lost sales, but permanent loss of future market access. Macroeconomic data reflected the pain. U.S. GDP growth slowed to 1.2%, business investment shrank, and the Federal Reserve considered rate cuts. Tariffs raised prices for consumers, costing the average family an extra $1,000 a year. Everyday goods from electronics to clothing became more expensive. Rising unemployment risk and higher prices created a tough environment for millions of Americans. The trade war was no longer abstract. It was hitting wallets and jobs across the country. The economic fallout was deep and widespread. The U.S. China trade war is fundamentally reshaping global manufacturing and supply chains. The old model of efficiency and just-in-time production has given way to a new focus on resilience and redundancy. Companies are diversifying away from China, building capacity in Vietnam, Mexico, India, and beyond. This shift is costly and complex, disrupting established networks and raising prices. The world is fragmenting into regional trading blocks, reducing global efficiency and increasing costs for everyone. Economic ties are now aligning with geopolitical alliances, accelerating the decoupling of the U.S. and Chinese economies. Strategic sectors like technology and defense are splitting along national lines. The stress on supply chains signals a deeper realignment of the global order. The era of hyper-globalization is giving way to a more fractured, competitive world. The 2025 tariff escalation and Boeing's production pause reveal the harsh realities of modern geoeconomics. Trade policy is now a tool of statecraft, with immediate consequences for workers and industries worldwide. China's precise retaliation showed how market power can be weaponized, turning Boeing into a casualty of geopolitical rivalry. The fallout rippled through agriculture, tech, and the broader U.S. economy, forcing a painful rethinking of global supply chains. The world is moving from integration to fragmentation, with higher costs and greater uncertainty. The events of 2025 exposed the fragility of the global trading system and the potency of non-tariff barriers. As Washington and Beijing return to the negotiating table, deep mistrust and unresolved disputes remain. The big question: Is this a temporary disruption or the start of a permanent fracture that will define the global economy for years to come?